My name is John Dowdy, and I'd like to give you a quick review of the stock market for the week ending August 9th, 2013. I call this review consolidation because that's what the market did last week. It consolidated in a tight range, and we'll discuss that more as the video proceeds. After watching the video, if you'd like more data, please come to my website, www.superchargedretirementIncome.com. Now, what this show is based on is called technical analysis. Technical analysis is the analysis of charts. Some people believe it works, some people don't. I believe it does work in some cases, and if you'd like more data on that, please read my post at the website. Today, we're going to have an agenda where we will first review two patterns from a couple of weeks ago. That was the week ending 8/2. We'll look at a range breakout and also a cup and handle pattern and see if they're still in effect. Then we'll look at the action from last week. Okay, this is the range breakout pattern that was in force 8/2/13. And as you can see, this was a pattern that range of 2.5 points from about 167.5 to 170. Thursday and Friday of 2 weeks ago, we did break out from that range and went above the 170 level. Since the range was 2.5 points, we expected to move 2.5 points above the breakout point, which would have been a measured target of 172.5. But however, this week we moved back below the breakout point, and we're now back within this range. And so this pattern has been killed. This pattern is no longer in force. That's what happens in technical analysis when you're looking at a pattern, and if it gets killed, then it's no longer in force. The next pattern that we looked at was the cup and handle pattern. Now this pattern had been developing since May, and as you can see, there's a cup and then what we call the handle up in the last few weeks. Again, last couple of weeks, we did break out from that cup and handle, and we broke up above 170. Now the cup and handle line is around 169. So we broke out the 170, and then the range of the cup and handle, the depth of the cup was 14 points. So we added that to 169 to get a merchant move target of 183. Last week we did pull back, but we did not break the handle. We pulled back to around 169 on a closing basis, and that did not break the handle. So this pattern is still in play. We still expect to meet the immersion move of 183, and this pattern will stay in play until either we meet the immersion move target 183 or we break the handle and move back in the range. Okay, let's look at the S&P daily view. This is a chart of SPY, which is the S&P 500 ETF. And as you can see, we have three moving averages, 20, 50, and 200 day. The 20-day is acting as support right now. Last week, the 20-day was acting as good support. We're still in about the top part of the range, and it looks like we're consolidating. We're above the breakout point, which was the high in May of 169.07. So as long as we stay above that breakout point, the bull is healthy. Last week we did consolidate and pull back to the breakout point, which is called a throwback, which is not unusual. Now usually if you have a throwback, the next week or two will provide a nice bounce. So that's what we would look for. We'd like to see a bounce away from the breakout point, and that would confirm the bull market and confirm the breakout. But if we move back within the range, then we'll have to take a look at the bull market. There is strong, very strong support at 165, which is the 50-day moving average and the bottom of the channel. So I would expect 165 will hold even if we start moving downward. If we broke 165, then we'd have to reassess. We could be in for a significant correction if we broke 165. So, summary. The bull did lose about 1% last week and is in a consolidation mode. However, we're still above support at 169, so the bull is healthy. We have seen a couple of patterns, bullish patterns. One was a short-term range breakout, which was killed last week. That is no longer in force. But the cup and handle, which is the larger pattern, with a merchant move target of 183, is still in force. And we'll have to see if that plays out to completion. Longer term, We have very strong support at 165, which is both the bottom of the channel and the 50-day moving average. As long as we can stay above 165, the bull is healthy. Don't have to worry too much. But keep an eye on the market, see if this breakout is confirmed, and if the breakout gets confirmed, then we'll be looking towards 183. However, if we move back into the range, then we'll have to reassess. Quick legal disclaimer: this video is my opinion and my opinion only, and should not be construed as any investment advice or an offer to buy or sell any security. You are responsible for your own investment decisions. And of course, when you invest, you could lose. And past performance does not indicate future profits. So with those caveats, let me just wish you good luck. Hopefully we'll have a good market next week. Thanks for viewing, and if you'd like more data, please come to my website, www.superchargedretirementIncome.com. Thanks.